Hi everybody, I hope you're well, and hopefully not in self-quarantine. Sure, it's been some interesting times over the past couple of weeks, and yeah, coronavirus has really hit not only South Africa hard, we haven't been hit hard yet, but the whole world. So it's some very, very difficult times we're living in, and then compounded by the oil wars between the likes of Saudi Arabia and Russia. Doesn't make life easy at all, and has really played havoc with the markets. But obviously, that's why I'm sending this to you today. As you would have seen in my previous email, obviously, as Resolute Wealth Management, we've taken the decision that we need to be responsible, and we're not seeing clients at this point in time face to face, mainly because we want to take the initiative to try and stop the spread of the coronavirus. Not saying that any staff have got it, any of our clients have got it, but obviously we need to be as careful as possible to try and assist in stopping the spread of the coronavirus. That being said, obviously I am available on chats such as this, Zoom chats, WhatsApp chats, via telephone, via email, or any other means that we need to. That's the beauty of technology. It has made the world very, very small, and we are able to do things like this. So please, if you need to chat or need any sort of information, please get hold of me. As you can see, I am in my office. It's business as usual. All of the other staff are in the office as well. We also have made plans that should the country go into lockdown, we've got to start working from home, as has happened in many other parts of the world. We are able to work remotely, still stay in contact with everybody, so it will be business as usual. So please do not worry about that. But yeah, obviously there's a market update and a couple of slides that I'd actually like to take you through so that you've got a better understanding, obviously, of what has happened in the markets, what it means for us as investors and what we should do, and obviously what sort of opportunities and why it creates opportunities when markets do this sort of thing. So please bear with me. I will try to keep it as quick as possible, but obviously I just want to make sure it is as comprehensive as possible as well. Obviously, should you have any family, friends, or whatever that are concerned with the goings on and don't have a full understanding, please, by all means, feel free to forward this on to them. It's no trade secrets in it. I think the rest of the market is talking about very similar things. I just think it's very important that I obviously touch base with you and that you do know what we're thinking as Resolute Wealth Management as well. Right, let's get started and move on to the slides. If we take a look at obviously what is happening, it's really been two black swan events. So it's the coronavirus as mentioned, the oil wars as mentioned. So coronavirus, everybody knows about that, and hopefully is being as cautious as possible. We know in South Africa there's not been a lockdown yet, but they are clamping down more and more on where you can actually interact with people, how much interaction you do have with people. And I think as individuals, we're all responsible enough to be able to limit our exposure, but obviously the government has to be seen as doing something as well, and it's their responsibility to do things for those people who can't manage their own social lives. And then obviously, as I mentioned, the oil wars very much between Saudi Arabia and Russia. And obviously when the oil consumption dropped, Saudi Arabia wanted to cut production. Russia said, no, we're not going to cut production. So Saudi Arabia thought they would take it on themselves to teach Russia a lesson, and actually said, well, we are going to increase output. Saudi Arabia at this point in time, as we heard at a presentation we were at last week, at $2 a barrel, they're still profitable. So when we're sitting down at $25, $26, $27 a barrel, they're quite happy, they're still making money. Hence, they increased their output, and Russia obviously feeling the brunt of it all. Um, the spread of coronaviruses, obviously at the time when the slide was put together, total deaths were sitting at 8,007, total cases was 201,530. Today we've heard our number has climbed over the 200 marker, and I think we're going to see some steep inclines in those numbers going forward. That is just the way it works. You have one person who gets it, two people get it, four people, eight, and so on. But I think the country is doing a good job of making people aware, putting regulations in place to try and stop the spread of it. So I think in South Africa, as long as we're all responsible, we'll be able to come out of it relatively unscathed, but it's still going to be a long process. The total cases, as you can see, as mentioned, and as I said, it started off very low at the beginning of January when it was first announced by China, or obviously after they eventually let everybody know. But as expected, you can see how it has ramped up. Obviously, what we want to see is a little bit more of a flattening of that line and eventually of it coming down. I don't think coronavirus is something we're going to completely eradicate, but as long as we can minimize it so that it can be manageable in the future, as opposed to being a pandemic as it has been called at this point in time, I think we'll be okay. Taking a look at what has happened in China, looking at confirmed cases, which is in this light gray area, you can see how that has dipped completely. You can see how patients who have contracted coronavirus have actually been leaving hospital because they've gotten better. Severe cases didn't get too high, obviously, because we know the main people at risk are unfortunately people who are older in age. The younger you are, it seems the better you can fight against it, or your immune system can fight against it. But even those severe cases have dropped off quite nicely. Deaths seem to have flatlined, and maybe not the best choice of words concerning it is deaths, but it really has done just that. You will find that this black section will drop and hopefully come down to very much zero. So it is very good. China have also said 2 days ago they had no cases of transfers within China, only people who'd been traveling abroad who were bringing it back again, and new cases reported. So China really do have it under control, especially considering they've closed their last coronavirus hospital. They've done an incredible job at making sure they can manage it. Oil wars, I think they are here to stay for at least the near future. I've already explained to you, obviously, what happened between Saudi Arabia and Russia, which has driven down the oil price tremendously. So obviously, we're going to see at the pumps a good savings, money in our pocket, even after the increased levies that the government has put onto the price of petrol with the new budget. We're probably going to see an 80 to 90 cents per litre saving in petrol and per tank. That makes a good savings and better in your pocket than in the government's pocket at this point in time. So we can enjoy that. I think the oil price is probably going to stay relatively low for the foreseeable future, and I don't think we're necessarily going to get quite up to those levels that we have seen in the past, but obviously only time will tell. The historical oil price, obviously, you can see has taken a huge dip at this point in time, and as mentioned too, I think it's sitting at $27 a barrel at this point in time. We've obviously seen very big dips like this in the past. Usually it's come when we've had things like the tech bubble, the housing crisis of 2008, and obviously you can call this the coronavirus crisis of 2020 that's seeing it. But I think what we'll see is, as opposed to seeing a really big spike back up in the oil price, I think we're going to see maybe a little bit of a slower trend up in the oil price. With Sasol obviously being a huge player when it comes to oil, they've taken a big knock, and their share price has actually fallen by 95% since their highs. It's not only because of these oil wars, it also does come on the back of the problems that they've had with the cracker at Lake Charles. And I think a little bit of mismanagement from that point of view. Don't get me wrong, they've got nothing wrong with their financials. It's not as if it's a matter of mismanagement and people stealing or inappropriate use of funds. It's definitely not a Steinhoff case, but they have had some very difficult times. Obviously, speaking again to the fund managers recently, they do feel that Sasol is too big to fail. Less than 5% chance of Sasol actually going under, and I think it is a very good buying opportunity possibly, but I think a cautious buying opportunity, and I think the fund managers will be watching that, but they'll be very cautious. They'll hold what they do have and obviously follow the trends upwards. At this point in time, Lake Charles cracker is actually making money for Sasol, which is a great thing. Therefore, they are still very profitable. They're still making money at oil at the rates that it is currently at. So I think you will see a rebound on that price. How long it will take, nobody knows. And when it will happen, we're not quite sure. But obviously, as South Africans, we want Sasol to succeed, and I'm sure they will. So what impact has the coronavirus and oil had on our economies, both locally and globally? Well, if you take a look at just the S&P 500 index, you can see obviously the 10 biggest one-day declines, and you can see the 16th of the 3rd, the 12th of the 3rd, and actually the 9th of the 3rd, 3rd being March, are 3 days out of those 10 of the biggest falls in any given one day in the markets. So obviously this has had a huge effect on our economy. If you take a look at the NASDAQ, S&P 500 and the Dow Jones over the past 3 months, nearly 3 months from the beginning of the year, you can see how everything trended upwards, and then coronavirus obviously took effect along with the oil wars, and in February the prices started to drop, and you can see it sitting somewhere around about the 2025, and at this point in time even possibly around about the 30% down. The markets are down. If you take a look at our JSE, also our JSE is sitting at around about 30% down. But if you take a look at today has bounced back. At one stage it was over 8%. It's currently just under 6% that has bounced back for the day alone. So we do feel that there will be a strong recovery coming in both local and global markets. And again, just to take a look at how quickly things have gone down. If you take a look at the blue line actually shows the tech bubble, and that obviously took over 600 trading days to drop as low as what it did. The financial crisis of 2007 to 2009, obviously that took just under a year, which is that red line. Obviously those numbers are far, far more dire than what the numbers are currently. Is that the coronavirus, you can see the drop has been far more drastic, which is an event-driven bear market, showing down by 30%, but obviously it's come down very, very quickly. There is a very big difference between structural bear markets, cyclical bear markets, and event-driven bear markets. As you can see, event-driven bear markets on average fall by about 29%, which is exactly what we've seen so far. Hence, we feel, along with Morningstar, who help build our portfolios and choose the funds we invest in, they do feel that we are sitting very close to the bottom, if not at the bottom, and we should see some sort of recovery coming through very soon. Even though we might see some very big swings still, where it goes up by a good couple of percent and comes back down by a good couple of percent, but we're hoping that the market shouldn't fall really further than where it currently is at this point in time. Obviously, we're also seeing a very weak rand at this point. As markets recover, and I think coronavirus is brought under control, we will see a little bit of a weakening in the South African rand, but we do know that the South African rand in the long term is always going to weaken against the established currencies such as the dollar, the euro, the sterling, and those sort of things. Hence, obviously, it's always good to have that offshore exposure. But taking a look at recoveries, and you can see this is the financial crisis of 2008, and you can see, as mentioned, it took just over a year, obviously, for everything to finalize with that crisis. But obviously, we saw over a period of 593 days, the markets went back up. So less than 2 years, the markets were right back up where they started, and they continued to grow from there. If you take a look at the 2001 9/11 tax, that took place in New York, in the US. That was a far bigger drop, which was event driven. And please remember, with this being coronavirus and the oil wars, this bear market that we've currently been experiencing is event driven. So we are thinking that we will have a V-shaped type of recovery with the markets. We have seen a very quick decline where it's taken only a month so far to decline where we are. But as can be seen over here with this event-driven market, bear market, it took only 28 days for the markets to recover. And we do think we will see a far, or at least a recovery that will happen quicker rather than being spread out over a number of years. Which is obviously a good thing for us as investors. And I do think the markets had probably used this as a bit of an excuse to create a correction in the market. We know there's been talk in the markets about global markets being overheated and overpriced for some time. It was the longest bull market run ever. Which was 2009 right up until obviously current. So I think a lot of it, the panic selling wasn't only because of coronavirus, only because of the oil wars, but I think a lot of people also just felt that a correction had to come through, and they used it as a bit of an excuse to get that correction now. Correction in markets is always healthy because it resets and it creates buying opportunities for investors and fund managers alike. Obviously, what do we do at this point in time? It's very important that we stay the course that we're in. Obviously, you've been invested in the type of portfolios with the type of exposure that you do currently have because of the time horizon that you have got to, or at least do have as an investor. Obviously, if you had a short time horizon, you would be more in the income type portfolios and income type funds, which are high in cash, high in bonds, and very low risk. They would have had very little effect from this downturn in the market. Obviously, if you're a longer investor, you want to have exposure to growth assets. Therefore, you invested with probably high levels of equity and a little bit of property, not much, because we know property has been a very difficult asset class at this point in time. And obviously, you would have had a bigger drop in your investment values, but still not as much of a drop as what the actual indices had. So if you were invested in a tracker fund or a passive fund that, say, tracks the S&P 500 or tracks the JSE, you would have dropped by about the same amount, 30%, as what their indice has dropped. Whereas in the portfolios, because we are diversified across cash, bonds, property, and equities, and also diversified locally and globally, you have had far less of a drop, where that drop was maybe halved. So if the JSE or the S&P fell by 30%, you might have seen a 15% drop in your investment, but obviously it's quite normal, nothing to panic about, and business as usual. It is very important to stay the course. If we take a look at this graph, and if you can see this red line, if a person had have gotten out and gone off the market and gone into money market halfway through the drop, and then only gotten in after the markets had started going back up, they would have been worse off at 282,000 as opposed to if they had have stayed invested as per the light blue line, and seen the market through, where they would have been at 301,000 after the entire period from 2006 to the end of December 2019. If you had have gotten out of the market at the bottom, which is where we currently say and hope we are, and you had have gone into money market and only gone back into equities and growth assets about a year later, you could have seen the damage that would have been done would have been far more severe, and you would have only had a value of 243,000 from a starting value of 100,000 as opposed to 301,000. And if you had gone into money market and remained in money market, your value would have been even lower at 160,849. So even though we know money market is guaranteed, the returns that you do receive over the short term and the long term are far lower than what you're going to get over those growth assets. So although we know it's at times very difficult to do, the best thing is to just sit on your hands, close your eyes, and ride it out. And I can promise you, over the long run, you're going to be very happy that you did, because you will be sitting on the blue line at the top of the returns over there. Another reason, obviously, why we want to stay the course is if you take a look at this graph, these blue lines at the bottom over here are showing the biggest drops in the FTSE JSE All Share Index, and the FTSE JSE All Share Index top 10 worst days. We actually have 3 of those days as well in there. But if you look at the subsequent returns, the 12-month returns, which are following that big drop, in the orange line, you can see they've had some phenomenal returns. Yes, 1 or 2 months where they've been a negative return still for the subsequent year, 12 months. But if you then carry on further and you take a look at the grey line shows the annualized return over the next 5 years. And you can see again phenomenal returns, all of them being double digits, some of them being into the 20s, even into 30s, 40s, and even 50% returns in the 1 year. And obviously in the 5 years, again, as I mentioned, double digits throughout. So obviously we just need to stay the course, and we will get the benefit of the recovery of the market. Last slide that I have for you, this just obviously shows again, as per the previous slide, the subsequent returns that have been achieved after the big drops. You can see the average drop is over 21 months. We've been far shorter, so let's even compare it to these ones that have taken 3 months. And you can see the subsequent 1-year returns are 21%, 29% over a 12-month period. Over a 5-year period, 96% over that 5-year period, 93% over that 5-year period. That's very close to a 20% return per annum. Over the 10-year period following that big drawdown, 361% and 334%. So the returns after having big drawdowns are phenomenal. That's why we need to stay invested in the markets. Obviously, we want to diversify our portfolios, which we would have had where we've taken some form of risk, but obviously we are invested in cash and other parts of it. So your portfolio is well diversified. But I think if there's one thing that our market does show, and history does teach us, is that it's times like these are actually buying opportunities for our clients. If you feel that you are sitting on some cash that you would like to obviously put into investments or equities, obviously you're uncertain when is a good time to do it. As long as your investment horizon is relatively long, and by relatively long, I'm talking 5 years plus, I do recommend that now we look to put it into the growth portfolios in order for you to be able to take advantage of these type of returns that will be achieved after this drawdown. The coronavirus we are going to see, and or have already started seeing, is very much under control, but unfortunately we can't stop the spread in certain areas because we need to identify who all has contracted the virus first. But just like China, where their numbers are dropping, it'll drop in the rest of the world, it'll drop in South Africa, and this will pass. Same with the oil wars. As much as Saudi Arabia are making profit still, they want to make more profit than what they're making. And this too will pass. So it does give us a great buying opportunity at this point in time. But yeah, that being said, that is my story. That is a little bit of an update. I hope, obviously, I have explained it clearly enough. If you do have any questions, if you would like me to send you copies of these slides, please, by all means, I'm more than happy to do so. And if you want to chat about any queries, concerns, questions you may have, please give me a shout, and more than happy to chat. And yeah, hopefully everything will be back to normal. We'll obviously be able to have our face-to-face meetings again. It'll be lovely to be able to get out of the office, and especially over weekends, get out of the house again. But yeah, otherwise we've just all got to keep fighting the good fight, and we will chat soon. Thanks very much. See you soon. Bye-bye.